Picture yourself driving at 100 km/h on an expressway. A sudden speed breaker appears. If you're buckled up with airbags, you feel a jolt but you're safe. Without a seat belt, the same jolt becomes a crash. In trading, the stop loss is that seat belt and airbag combo. Market jolts arrive daily: earnings, macro news, policy moves, global risk. Traders who buckle up survive those surprises, those who don't are exposed. The big idea: no stop loss, no trade. 3 common reasons. 1. Hope and ego. It will come back. My analysis can't be wrong. 2. Overconfidence. I'm watching the screen. I'll exit in time. A sharp gap down or flash move makes manual exit impossible. 3. Pain avoidance. Booking a small loss hurts, so they delay. Small losses grow into big ones. Like many beginners, Ravi first removes his tight SL, give it more room, then averages down, and eventually loses 30 to 40% of the account. Reality: skipping a stop loss invites emotion. Emotion destroys plans. Markets are uncertain. The only variable you truly control is risk per trade.
Over 93% of traders lose money in the markets, not because of the market, but because of their mindset. Hi, I'm GC Sharma, founder of Ghar Ghar Investor, former head of financial education at the National Stock Exchange. After 3 decades in the markets, I'm here to help you trade with discipline, not emotion. Welcome to Bounce Back Trader, India's free YouTube learning series for traders who want to bounce back with clarity and confidence.
Traders who use fixed, rule-based stop losses tend to survive longer, even with fewer trades. Retail losses are typically driven by the trio: overtrading plus no SL plus averaging down. Practical edge: automated orders, SL, SLM, OCO, bracket, GTT, keep emotions out. You pre-commit your decision so your platform executes the plan while your mind stays calm. Pre-commitment is the disciplined trader's best friend. If my SL hits, my analysis was wrong. Not necessarily. A stop loss is risk control, not a judgment of your intelligence. Tight SLs get hit too often. Tight stops get hit when they're placed arbitrarily. Use structure or ATR to reduce noise. I can tolerate paper losses. Paper losses are real, your capital is locked and the opportunity cost is huge. I'll skip the SL today, I'll follow from tomorrow. That's procrastination. Break a rule once, and it becomes easier to break again. Mindset shift: stop loss equals fee, insurance. You don't hate your helmet for saving you, treat SL the same way. Ravi, no SL, averages down, buys at 500 rupees. Slides to 480 rupees to 460 rupees, adds more. At 420 rupees, he hopes. Outcome: 40% capital, plus 100% stress. Neha, pre-committed SL, same entry at 500 rupees with SL at 480 rupees, below structure. Gets hit, 20 rupees per share, controlled damage, clear mind for the next trade. Arjun, intraday, no SL, after 15 green days, one sharp reversal wipes the month's gains in a day. Lesson: edge equals risk control. Kavita, swing with ATR stop, ATR equals 20 rupees, entry 500 rupees, SL equals 500 minus 1.5 times 20 equals 470 rupees. Small, planned losses, lower stress. Index gap down, overnight shock gaps the index 2% lower. Manual exits fail, those with SLM, GTT limit the damage. High volatility names, crypto, SME, trading them without SL is like swimming far into the sea without a life jacket. 1 fixed % risk plus position sizing set per trade risk at 0.5 to 1.0% of account for beginners, max 2% for experienced. Example: account 200,000 rupees, risk 1% equals 2,000 rupees. Entry 500 rupees, SL 480 rupees rightwards double arrow risk, share 20 rupees rightwards double arrow position equals 2020 rupees equals 100 shares. If SL hits, the loss stays rupees 2000, not your whole account. 2 structure-based, technical stops place SL just beyond a logical level, below a higher low, under a validated support, or above a swing high if short. Logical stops reduce random whipsaws. 3 ATR-based stops. ATR measures volatility. Example, ATR equals 12 rupees, entry 240 rupees, SL equals 240 minus 1.5 times 12 equals 222 rupees. In trending markets, an ATR stop lets trades breathe. 4 trailing stops, TSL, as price moves in your favor, trail the stop by a fixed step or behind a moving average structure. Idea: let winners run, keep losers small. 5 partial profit plus TSL book part at target 1, trail the rest. That lowers emotional pressure and sustains process fidelity. 6 automation, OCO, bracket, GTT, SLM. Place entry plus target plus SL together. If you're right, target or TSL does the job. If wrong, SL exits you automatically. Human bias stays out. 7 journal prompts, simple and practical. Write for each trade: where is my SL? Why there? Did I move it? What happened? Weekly review: out of 10 trades, how many were SL compliant? 8 tenths plus equals strong, 6 tenths equals building, less than 5, 10 equals reset and train. Bonus: where to place the stop, checklist. Not too tight, beyond random noise, use ATR or structure. Not too loose, it must represent thesis invalidation, not wishful thinking. Consistent method: always derive stops the same way to build repeatability. Align with position size: wider stops right pointing arrow smaller position, tighter stops right pointing arrow smaller risk per share. Top message: you trade tomorrow only if your capital survives today. The stop loss keeps it alive. Immediate actions: put a sticky note, no SL equals no trade. Fix your per trade risk, 0.5 to 1.0% to start. Learn and practice your broker's OCO, GTT, SLM flow, make it a habit. Calculate position size, always by math, never by gut feel. Final metaphor: on a train, the emergency chain isn't optional. In a crisis, it's the difference between safety and disaster. In trading, your emergency chain is the stop loss. Click the seatbelt on every single trade, starting now.
You've just completed another lesson of Bounce Back Trader. Remember, trade with discipline, not emotion. Subscribe to the channel, share your thoughts in the comments, and continue your journey in the next video. Let's change that 93% story.